Hi folks, and welcome back to Meaningful Money. Okay, I'm still here at Merry Maidens because it's just such a beautiful day, beautiful spot, not a cloud in the sky behind me. Still here with my petrified maidens though, who were turned into stone for having a bit of fun on a Sunday. But we need now to talk about the last of the four main personal taxes. We've covered income tax, national insurance, capital gains tax, and now finally inheritance tax. Now, inheritance tax is levied, that means it's charged on the value of your estate when you die. Seems a bit rough, still being taxed even when you're a goner, but such is life and death. Your estate is everything you own less everything you owe. So, if all you have in the world is your property and it's worth £300,000 and you've got a £200,000 mortgage on it, then your estate is £100,000. It's a simple sum, add it all up, take off whatever you owe, and what's left is your estate. First thing to say is that everybody has an allowance, and we call that allowance the nil rate band because it's zero nil rate. Tax is charged at zero, which is nothing, obviously, on that band. And the band is the first £325,000 of your estate. So, if your estate is worth less than 325 grand, good news, no tax to pay. The problem is that in recent times, house prices have been rising so fast that many ordinary people are now caught by this tax, whereas they weren't, say, 15, 20 years ago. So, it's a problem. Whatever you have, whatever the value of your estate is in excess of the 325,000, well, I'm afraid you're going to pay a whopping 40% tax on that. So that's pretty extreme. And they call inheritance tax the voluntary tax because there's so many ways you can reduce your liability to it. So let's talk about some of those. First thing to say is that everybody gets that nil rate band, the 325,000, and if you're married, you can transfer your nil rate band to your spouse. So let's say I die first and I leave everything to my wife. Well, when she dies, she gets my nil rate band and hers. So when she dies, she gets £650,000, which she can leave to the next generation tax-free. Anything in excess of that is the 40% again. That's quite a recent development and a very positive one. Now, that's the obvious way is obviously to spend as much as you can just before you die, and then it's all gone, and there's no tax to pay. But unfortunately, we don't know when we're going to die, so we need to be a bit more intelligent about it than that. The first thing I think as to how to reduce your liability to these taxes, the obvious thing to do would be to give all your money away on your deathbed. Let's say you're in hospital and the doctor gives you a week to live, you sign everything away and there's no tax to pay. Well, I'm afraid the government has thought of that ahead. You can't give away money, or you can, but if you die within 7 years of giving it away, then it's added back into your estate anyway when you die, so you're not gaining anything. Now, it's added back into your estate on a sliding scale, so after the sort of 6th year, only 20% of what you give away is added back into your estate, but still, it means you can't do deathbed financial planning for inheritance tax, I'm afraid. Some useful things you can do, though. Everybody gets an annual a gift exemption of £3,000. So every person, as me, can give away one amount of £3,000 per year, and that gift is not counted for inheritance tax planning purposes. So it's a way I can get rid of my money. If I've got all the money I need, I can get rid of it over time by giving £3,000 a year away to a deserving person. I can also give as many little gifts of £250 to as many people as I want. Now, that doesn't mean I can give my daughter sort of 100 cheques of £250, much as I'd like to, but it's £250 to a different person. So as many of those as you want. That's quite a useful allowance. Probably the most underused allowance, though, is something called gifts from income. And all that means is you can make regular gifts. There's no real definition of what regular means, but let's just say annual, of as much as you want, as long as it comes out of your income and as long as it does not affect your standard of living. So let's say I have an income of £50,000 and I spend to live £30,000 a year. Well, I can give away the difference between those two, £20,000 every year, and even though that's above all the other exemptions, and that's quite a lot of money, that would be deemed to be a gift from income and would be fine for inheritance tax purposes. It wouldn't cause me or my beneficiaries any problems at all. The last little exemption that's worth mentioning is gifts on weddings. So if my daughter gets married, I can give her £5,000 because I'm a parent, and my wife can do the same without it being a problem for inheritance tax planning. Grandparents of the bride or groom or remoter family can give £2,500 as a one-off for a wedding. Anybody else can give £1,000 for a wedding as a one-off. And the final exemption, the biggest one really, is that gifts to charity, either before death or through a will, are exempt from inheritance tax. So the best way to have zero inheritance tax is either to spend it all on the biggest party of your life about a week before you die, or to give it away to your favourite charity. So there are ways you can plan for inheritance tax, but it's basically you spend your money, so there's no tax to pay. You give it away to charity, so there's no tax to pay. You make use of these exemptions, or you can also take out life assurance to cover whatever the inheritance tax bill might be, but we'll come back to that. So, a couple of other things to mention. You can't give something away in a bid to sort of try and reduce your estate for inheritance tax and still get a benefit from it. So I couldn't, for example, in my old age, give my house to my kids but continue to live in it. Well, I could, but it wouldn't work for inheritance tax planning purposes. That property would still be deemed to be in my estate. And there's another set of rules which are called the pre-owned asset rules, which means that if, basically the same thing, if I'm still getting a benefit from something I've previously owned but given away or sold at less than its value, then I can be taxed on the benefit that I'm getting from it. So that's not a good move either. So every angle you can think of to get around inheritance tax, the revenue has got there first, but there are some legitimate angles for inheritance tax which we'll come to. And that leads me on really, because we've talked about the 4 taxes. I talked in the introduction to this sort of little mini-series that I happen to think that trying to remove and reduce your liability to tax completely is immoral. I think, if we're going to drive on roads and use hospitals and things like that, we should be paying tax to a point. But there are legitimate ways you can reduce your tax bill and still sleep at night, or at least for me to sleep at night as your financial planner. So we'll talk about those over the next 2 or 3 videos, just some ways you can sensibly and legally reduce your tax bill. So I hope these introductions to the taxes have been useful. Leave any comments in the comments boxes as usual, and I'll do my best to answer any questions. But for now, from the Merry Maidens, thanks very much for watching, and I'll see you next time.